Hey, it's Chris, January 22nd, 2024. I thought I'd do a video that I'm going to call Market Stats and try and do it somewhat consistently because I sort of obsess about how to invest and if we should invest in stocks or bonds and how to get the best results. And, it's somewhat easy maybe to do it here at a macro level, but then when it comes to individuals, you have to drill down. So everyone has their risk tolerance and their preferences. But essentially, every month, I have a spreadsheet that I update every month. And the spreadsheet compares stock returns to bond returns. And for the stock returns, I use the S&P 500 index. And for bond returns, I use the Bloomberg Aggregate Bond Index. So that being said, the the data goes back 74 years to January 1950, so there's a lot of data here. And it's also all historically looking, so it's not a predictor of what might happen from this point forward. Past returns are not indicative of future results, but some of it is indicative or indicative, maybe not predictive. Indicative, I think, is the word. These are not projections; they're historic results, chances, probabilities, historic probabilities of success. That's what they are. And will the future probabilities equal the same as the historic? Not to the decimal. Presumably, they'll look very similar. So that's a whole big explanation of what's going on here. It's stocks versus bonds and helping folks to decide how to invest monies. And, there's cash flows. I mean, this data is point-to-point data, but when you have cash flows, meaning you're contributing monies every month, contributing monies every year, withdrawing monies every month or withdrawing monies every year, cash flows can change the results of a portfolio significantly. If you invest a lump sum of money and you take a 10-year nap, more times than not, stocks are going to provide better results than bonds. But if you invest a sum of money and you constantly attend to it, put money in, take money out, the results can change significantly, especially in a decumulation phase. Someone who's distributing money. And I guess that's why there's so much research and videos on what's called your asset allocation, the amount you put into stocks and bonds. And it's because when you start taking money out, that's when it all changes. So that's enough. Let's get into it. I'll show you what I've been up to. We'll validate it somewhat through some websites. And so let's get to getting. If I share my screen here, and what we're looking at is historical index probabilities. The S&P price index. Price index does not include dividends. The price index is when you go look up what the S&P 500 is and you get a number. That's the price index number for more than likely it's the price index number. And so that's what I use here. It's super easily available. You can fact check me left and right because it's just such an easy reference point. And what this spreadsheet calculates is from January 1950, which is sort of the data I'm able to get through the S&P and through Yahoo Finance as well. I can go back to 1950 pretty easily. So it's 74 years of data. I think that's probably pretty good. And again, it's sort of making a point here at one level, but also a cautionary tale at another. So since January 1950 through December 23rd, so through the end of the year, December 2023, again, we're in 2024 right now, so all this information is known. There have been well, 74 years, but 888 one-month periods. And a one-month, period's pretty obvious, like, January of 1950 to February of 1950 is a one-month period. March of 2020 to March of 2021 is a one-month period. There have been 888 one-month periods, and going across, just to explain what this chart is, there have been 768 10-year periods, a 10-year period being January of 1950 until January of 1960, March of 1974 through March of 1984. That's a 10-year period, and there's been 768 of those. I think you get the gist. And what this chart will show is the amount of periods, the amount of times a period has had greater than 0 rates of return, less than or equal to 0 rates of return, the total periods, then on a percentage basis, what percentage of the time was a 1 month return positive, a 1 year return positive, what percentage was it negative? Now, what's been the average return for that marking period? The average returns when it's been positive, the average returns when it's been negative, the maximum returns for that period, and then the minimum returns for that period, right? So all these ways to look at the data that I feel are important. And so it's interesting if we look at, let's look at percentages, and we'll look at the amount of times for a 1 month period, and I guess the amount of times for a 1 month period that stocks have been positive and stocks have been negative. So 60% of the time, you're going to have a positive, historically you've had a positive month, and almost 40% of the time, stocks went down for a 1 month period. For 1 year, 73% of the time they increased and 26% of the time they decreased. Now I'm rounding, there's some decimals here, just go with me. Over a 5-year period, 83% of the time, stocks have been positive, 16% negative. And over a 10-year period, 92% of the time, stocks have been positive, 8% of the time they've been down after even a 10-year period. So that's when it gets concerning, is when we go through those longer bear periods, and we'll touch on those a little bit coming up. So those are stock results, and then I think what would be interesting is the average returns for such periods. Average 1 month return, 0.73. That seems like, and that, I guess that's right, because it's almost 9% a year on average. That's 0.73 times 12, 8.76, right? And there's some compounding and all that stuff. Okay. So then, for 5 years, we've averaged 50% positive. For 10 years, 120% positive. I mean, super stats as you go out further. And then the best and the worst results, I think this is very interesting. For a 1 year period, the best we've ever had is 53.71, and the worst 44. I mean, look, let's not miss. The worst 1 month we've ever had is almost 22%. When you go out further, which is what we're more interested in, for 10 years, the best 10-year period I have marked is 370% increase, and the worst 10-year period is a negative 40%. So, I mean, so $1 million could have been $600,000 after 10 years. I mean, that's just, you'd have been pretty disappointed. What would you have given up? Where would you, when would you have fired me in that period? I mean, I was here for it. Few people jump ship. But let's look at bonds. So those are stock stats for the period. Let's look at bond stats. Now, I only have bonds back to 1975. The bond index is kind of hard to track back terribly far. But it'll tell a similar story, but with a little less oomph. So similar to stocks, bonds have had, for a 1 month return, 66% of the time they're positive, 34% negative. That's kind of similar to stocks. For 1 year, they have better historical probabilities of success of this is only being greater than 0. It's not the average returns, it's being greater than 0. So bonds have a better chance of having positive results, although they also have a better chance of having less total return. So that's the trade-off. You're trading returns for predictability. And again, so for an accumulator, for 10 years, stocks have historically had a 92% success rate. Bonds have had a 100% success rate historically over that amount of time, right? These are not future projections. I'm just telling you what happened in the past. But the average increase for bonds over a 10-year period of 110%, where stocks are 119. So for 9% more, why not ride it out in stocks? And the best 10-year period bonds have had is 293, and the best 10-year period stocks have had is 370. Again, significant differences. And again, look, for 10 years on the downside, stocks went down by 40% over some 10-year period. Bonds, at worst, were positive 764. So you're trading some upside for predictability. And then, something that is to be considered, well, some people say, why ever invest in stocks? Well, or why ever invest in bonds? People are all over the map on this. So right now, for a 10-year U.S. government bond, you can get 4.1%. So using that as the bogey, right? Why would I invest in stocks if I can get 4.1% from the U.S. government, who is considered the safest investment in the world? Look, for a 10-year period, 77% of the time, you made more than 4.1. For 5 years, 71% of the time. And this stocks versus that 4.1. Let's call it a hurdle, if you would, please. Just call that a hurdle. So stocks have eclipsed the hurdle, and the hurdle is just the current 10-year Treasury rate. If it was a 5% rate, I'd plug in 5% in my spreadsheet. If it were 2%, I'd plug in 2%. And then just to clear it, because it's this big red thing, if you recall up here, stocks have not always been positive for a 10-year period. They indicate, these are 10-year gaps here. It's been positive all the time over a 20-year period. And so at one point in time, I got curious. I'm like, well, how long has it taken stocks to get positive? And that's what I did down here. I broke out years 10 through 20. And sometime between 13 and 14 years, historically, stocks have always been positive. So at the 14-year mark, historically, the worst return was 9.57, so it's greater than zero. Somewhere between 13 and 14 years historically. So if that were today, 2024, that means, historically it would be 2038 is when we'd more than likely see super high probability of positive results after that amount of time. That's a lot of time. Certainly a lot of time to wait for your investment to be worth more. But that's the game we play here. That's the nature of the beast. So then a little bit about the data, what I've done, how I do this. Every month I capture the closing level of the S&P 500 or the Bloomberg Aggregate Bond Index, and I just do a spreadsheet that does the change. So for 1 year, it's June to June of the year prior. For 3 years, June of the marking period versus June 3 years prior. So all the data's here. It's spreadsheet stuff. So the most important thing is for me to get the index levels right, and then once they're right, you just know Excel's just brilliant. It does the work for us. So, but then I love fact-checking me. I just love fact-checking everything. I don't take anything face value. So I'm here saying that 92% of the time we're positive over 10 years in stocks, 100% of the time historically with bonds, but the cash flow variable is always there, because when you start withdrawing monies, that's when things can get tough, and I think that's a good message in this. So there is a website named Portfolio Visualizer, and I'll show you some things because I've been through it. I kind of know when this stuff happens. And recently, although bonds have a good propensity for positive results, past few years has been very difficult for bonds. So now they're poised for success in 2024. Interest rates, we feel that the Federal Reserve is done raising rates, and may even decrease rates this year or cut rates, as they say. Don't know. If they don't, no problem. If they do, it enhances returns. If they raise rates again, it'll put bonds under pressure. But every increase now is not as impactful as it had been in the past. So a 1% increase, when your rates are 1% and you increase by 1%, it's 100% headwind. If we're at 4% today and they try and increase rates by 1%, it's called a 25% headwind. It's just not as impactful. It's not as damaging as those, what were aggressive cuts to begin with. So where I'm going with this is bonds have had, these are probabilities of success, but if you look at the total returns for bonds over the past 5 years, I mean, it's just been not fun. It's been not fun for conservative investors. Let's look at this. Let's look at 2019 through 2023, right? So 5 years, 19, 20, 1, 2, 3. Okay, 5 years. I can do math, and we do $1 million because big numbers are easy to look at. Total U.S. bonds, I just think that's the most fair way to do bonds. So using this portfolio visualizer website, it says that the total U.S. bond market investing $1 million 5 years ago was $1,048,000 after the 5-year period. I mean, was that 1% a year? Right. 10,000 is 1%. So 1% a year for 5 years is 50,000. So just under 1% rate. I mean, that's just, it's kind of not fun. See, here we were making positive success, and then they started raising rates. So bonds, the principal took a hit, although it was still paying interest, although negligible. Tough time for the past 5 years for bond investors. I mean, being conservative for the past 5 years has not been rewarded. But then as a contrast, let's put stocks here and then bonds second, so there's a comparison. Total U.S. bond market, portfolio 2, 100%. There's no rebalancing. I don't like rebalancing. Analyze. I mean, for the past 5 years, bonds have made $50,000 and stocks have doubled. So, but I'm hard pressed to find someone who's truly a conservative investor that had all their money in stocks. Conservative investors don't want to lose their principal. They're concerned more about their principal than they are about their interest rate or purchasing power. So conservative investors have been hard-pressed for the past 5 years, and aggressive investors, growth investors, have been absolutely rewarded. But as I mentioned, the cautionary tale is if you're taking money out. So let's just say we're withdrawing $60,000. And I just use that as some number. It's $5,000 a month, so $60,000 a year. I'm sure I could even set this to monthly, but I think annually it'll show the picture enough. So from one portfolio, we're going to have $1 million taking out 60,000, and the other $1 million taking out 60 stocks and bonds. So let's see what's happened for the past 5 years. The bond portfolio then ends at 725 and the stock portfolio at 1603. So still absolute advocacy for stocks over bonds during that time period. But if you recall on my sheet, we've had bond periods that have ended down 40%. And so the reason people continue to invest in bonds is to protect themselves against stocks. So like I said, I was here for these tough stock periods. And if you do something like the year 2000 to the year 2009, that's a 10-year period, $1 million, you have stocks and bonds, you're going to analyze the portfolio. This is a complete flip-flop from what we saw just a moment ago. $1 million in stocks after that 10-year period, taking out $60,000 a year was a final balance of $215,000. The bond ending balance was only down by $70,000. So these market conditions are, still in our minds. There's an awareness. Will this ever happen again? I can't say. If I can make any prediction, it's that these numbers will change over the next 10, 20, 30, 40 years, and they can change for the worst. I mean, we could have a 10-year period where stocks are down 50%. We could have a 10-year period where bonds are not positive. All right, so the downside is the risk. And yeah, if there's any one prediction I can make that will come true, it's that some record here will be broken. Bonds might have 3 negative years instead of 2. Stocks could be down 60% after 10 years, not 40 or 50. Records will be broken. I can't say what direction. I just absolutely convinced that they will. And so here's a situation whereby, stocks absolutely had a very tough time. And in fact, if we run that out further, I wonder if I run that out further, would they have run out of money? Would they have run out of money starting in the year 2000, $1 million, $60,000 withdrawal rate? Would a stock portfolio, final balance zero, stock portfolio would have run out of money after 14 years. Now, look, I fully acknowledge 6% a year is an aggressive withdrawal rate. I'm not advocating it. I'm saying nothing about withdrawal rates and all those, how much can I withdraw from my portfolio video, because that's another tough question. I'm obsessed about this. I mean, yeah, so what can you do? Well, look, you need $5,000 a month. You need $5,000 a month. Now, you don't need any money, then you'll more than likely be better off investing in stocks, but this is the opposite side. In a decumulation phase and with distribution phase, I say cash flows make such a big difference versus point-to-point investing. So again, the goal of this video is just market stats. It's focused on point-to-point investing, and it's focused on what a point-to-point investment would have done and your probabilities of success. But I also feel necessary to pepper in if it's not point-to-point and there's cash flows, and how cash flows can have a significant impact on your portfolio. So, put a link to my data sources down in the comments for, where I got the S&P data, the Bloomberg data. You can go to that portfolio visualizer site. It's pretty easy to use, and I use it as a validation of my data. I mean, I'm just using a spreadsheet here, and I'm going to presume that they have a little bit more sophisticated tools and software to run their analyses, and that's certainly a lot easier than spreadsheeting it. But I thought what would be cool was just, once in a while give you the market stats. And so when people ask, well, Chris, how can I possibly have the best results? We look at this, we talk about the historical data, we try to understand if there's going to be cash flows in a portfolio, what someone's risk tolerance is, and help decide. I mean, I've often said to people, there's a couple of ways to consider how to come up with your asset allocation. There's that 60-40 portfolio out there that everyone kind of defers to, and you can go 50-50. You can go all in one direction. But I ultimately tell people, I guess my best allocation is you put as much into bonds and cash as you need to feel comfortable, and then you put the rest into stocks. Now, when I say as much into bonds as you need to feel comfortable, it could be a dollar number. Hey, I need $100,000 of money's not in the stock market. I need $250,000 of money's not in the stock market. I need $500,000 of money's not in the stock market. Well, Chris, how much money should I not put in the stock market? Why don't you tell me? Sometimes it's difficult to answer. It's not always just, put $100,000 into bonds. You try to it's really necessary for you to answer the question yourself. So the amount in bonds could just be a number to make you feel comfortable. When we approach retirement, I ask people to start thinking in years of money. How much money do you need? Let's get this off for a sec here. Years of money. If you're going to withdraw, say that's using that $60,000 example, if you're going to withdraw $60,000 a year, So 3 years of money is $180,000. 5 years of money is $300,000. And so we'll play this. We'll play the odds. Listen, every 5 years we have historically we have an 83% chance of success with stocks, 16% chance of failure with stocks. Bonds are 99% with a 0.5% chance of failure historically again. Um, let's see. Why don't we put 5 years of withdrawals into bonds such that we have a super high probability of success that the non-bond, the stock portion, will have increased in that amount of time that you're withdrawing monies for 5 years. Your other bucket of funds, if you would please, that you're not withdrawing from has an 83% chance of success. If you need a higher probability of success, 10 years of money into bonds. The more you have in bonds, the more conservative your portfolio would be, the less your risk tolerance is. And so years of money has been, for me, a successful way to ask people to think about how much to have in bonds and then commensurately how much to have in stocks. But I thought, again, I kind of drift and I go on maybe a little bit here, but the probability of success of investing in stocks over different periods of time, clearly increases over time, as do bonds, but stocks can provide greater returns. They also can provide greater losses. And that's the trade-off. So hopefully you enjoyed this video. Thanks. See you back here soon.